What should an organization consider when designing a risk-based approach, which is RBA, to mitigate a financial crime risk? You have to select two. Option A, the size and complexity of the organization's operation. Option B, the number of personnel or resources on staff. Option C, eliminating opportunities to implement simplified measures. Option D, the nature and extent of money laundering and terrorist financing exposure. Option E, increasingly outsourced accountability to third parties and vendors. You have to select two, decide, and I'll show you the answer on the next screen. There you go. So option A and D are correct. Let's look at why option B, C, and E is wrong. So you see, option B is wrong. Look, how many people you have on the staff does not determine the type or the risk that you actually approach. Okay, so a lean compliance team, at a high risk institution still needs a robust control. Okay, so headcount is a resourcing question. It's not a designing, kind of a question in a way. Okay, option C, okay, which is eliminating opportunities. Okay, so simplified due diligence is a legitimate tool under the risk-based approach for genuinely low risk situations, okay, like salaried person. Okay, then eliminating it entirely goes against the whole principle of risk-based thinking, which is about applying the risk level of scrutiny, not maximum scrutiny everywhere. So you allocate your resources more where there are higher risk. Okay. Option E is also wrong. You can delegate tasks to third parties, but you cannot outsource accountability. Okay, the organization always remain responsible under AML frameworks. Increasingly, pushing accountability, outward is a governance failure. It's not a design principle. Okay, option A is correct, which is size and complexity. So imagine a small, credit union or small rep office or a small branch of a foreign bank. Okay, they cannot be an equivalent to a larger investment bank. Both pose a different, type of risk, and it should not be held to the same controls. So the risk-based approach must reflect the reality of the organizations designing it. Okay. The bigger and more complex the operation is, the broader and deeper the risk exposure, and the controls needed to match that. So one size doesn't fit all. Option D is also correct, which is nature and extent of the money laundering and terrorist financing. Okay, let's look at it. This is because the foundation of a risk-based approach. So before you design a single control, you need to understand what money laundering and terrorist financing risk your organization is actually exposed to, like your products, your services, your customers, your geography, your delivery channels. It depends. Like if you're providing trade transaction, if you have lots of e-channel options, or onboarding is digital. So many factors are there. So all of it actually shapes your risk picture. Okay, you cannot mitigate what you have not identified.